August 14th, 2019, guys. Good morning. 13 market moves daily. Short the bounces is back in style officially, guys. Looks like we're heading back all the way to 28.20 and lower. As a matter of fact, I'm going to show you some charts that could be possibly taking us all the way to 27.25, 27.50 level. So one of the things to observe in the markets, guys, and I know a lot of you were looking at the chart yesterday, you're like, oh, it's a bullish flag. Guys, when a bullish flag coincides with a very important level, as we identified over the course of the last week, that 29.31 is that level. And when stocks fail to break out above that level, on good news, guys, this is a sign you absolutely cannot ignore. This is the time to be a bear. When stocks fail to break key levels on what appears to be the greatest news of the day, that is an issue. That is an issue for the bulls. So we're temporarily switching our long-term bullish view. And over the course of the next 2 weeks, we're focusing specifically on shorting the bounces. That means anytime the market goes higher, we're going to short it intraday. And when it goes lower, we're going to trade around it. We're going to lock some positions. Overall, if you may not even have to do that, basically just want to get your entry right when the market bounces intraday and stay with your position over the course of about 72 hours to realize some great gains. So a great entry point today, for example, would be if the market bounces back to 2,900, because pre-market it's closer to like 2,990 levels. So I know these bullish flags could be confusing. That is, a bullish flag has never been one of our top chart patterns to really identify what's actually going to be taking place next. Because with a lot of bullish flags formations, they will make a pullback. And doesn't necessarily guarantee that the market will continue moving higher. So for those of you that have been studying that pattern, guys, it's not one of the best patterns. And, you know, it shouldn't be given that a ton of consideration. So buy puts out of the money, because VIX uptrend is officially confirmed. So last couple of days, we've been noticing these diversions on the VIX. And last night I sat down, kind of took a closer look. And at this point, this was not a really good case scenario over the last couple of days. It did point to the fact that the market will keep dropping further. But now that the VIX is back above 20 pre-market, it really confirms that uptrend. So at this point, it really makes sense to just buy puts out of the money and stay with your positions. Now, what makes it even more frightening and scary is the fact that if you look at the magnitude of this move 11, so if you pull up the 2-day, 2-minute chart, you're going to see this move 11. You're going to see this huge pyramid on a 2-day time frame, right? So the reason it's so serious is because typically, the grander the magnitude of a move 11, the bigger the drop that is actually going to follow it. So do not buy the dip today. Do not buy any kind of dip tomorrow. Anybody that's going to buy the dip over the next week is going to get slaughtered in this market. And I'll show you a picture why in just a second. So some of the positions, we're just going to take a quick review, why they still make sense and why, despite of the move higher yesterday, we kept sending the alerts to the entire group. Puts. Out of all the put messages that we've sent out, okay, there was only one call, okay, that did not materialize. And actually, that call is getting crashed this morning, which is another indication that, look, this is not the time to be a bull. This is the time to be a bear for the period of the next couple of weeks. Now, I want to do a quick basic review of the tunnel, because you got to absolutely understand this if you're day trading or swing trading, guys. What this tunnel means, when you see the yellow line, anytime the market gets there, what do you do with your bullish position? You sell them, you open puts. So this is the level, the high upper level of the trading tunnel, which coincides with 20. This lower part of this yellow line is 29.31, 29.31, 29.31, 29.31. Okay, when you see this, this is the time to get bearish. When you get closer to the red line, okay, it's time to start taking profits. Now, somebody mentioned yesterday in the group that, okay, I was buying puts at 27.75. Well, this is a horrible strategy because you don't want to be buying puts close to the lower part of the trading tunnel. So if our estimation is, and we kept saying in the video yesterday, right, 2860, 2870, 2860, 2870, 2860, 2870, okay, you don't want to be opening puts at 27.75. Okay, we specifically identified the upper trading part of the tunnel, which is right here. So this is where you want to start stair step and you want to start building your put positions. You want to add to your put positions here, but you don't want to be opening when it's clear as the sky to everybody, oh, the market is going lower. This is not the time you want to be buying puts. Okay, so today the market is down. We've sent out multiple messages in the group yesterday saying, hey, despite of this big positive move, okay, the market will be back to 2,900 today. It's actually trading lower pre-market, but the bottom line, you know, if you were afraid to pull the trigger yesterday when the market is going higher on buying puts, then this morning you're wishing you would have done that, but guess what? Don't make the second mistake. The second mistake would be buying puts at all day lows of the day. And you're going to be tempted to just pull the trigger. You're going to see the markets drop. You're going to be like, man, let me get into these puts. And as soon as you get, it will pop. It will reverse. It will bounce on you. So the idea here is to time this, okay? When you get closer to the upper trading tunnel, you want to begin to start buying puts. When that move is confirmed, you want to add some puts. When the move gets to the lower tunnel trading level, you want to start collecting gains. But in this particular case, with the developments in the market, okay, this level will be broken and will be adjusted. And notice, the lowest point on this chart is 2775.75, which was actually briefly created, not pre-market, but after hours, about 5 days ago, 6 days ago now. Now, notice we're saying we can actually go below that. So what you want to do intraday today, not buy puts right at the open, but buy puts on a bounce, like a 10-point bounce. Ideally, if we get closer back, so let's say we open at 2890, we make a 10-point bounce to 2900. That's where you want to buy puts. And then you want to basically stay with them and be patient for 3 days. Don't be doing this jump in, jump out kind of stuff. Well, let's say if you're trading 10 contracts, then, you know, don't sell all of them. Always keep some and call it your, you know, core position, if you will. So, you know, you can keep collecting gains on some of your positions. You get closer to these levels. But again, we're expecting this level right here to be readjusted on the way lower. And here's why. Guys, this is a very dangerous thing. I sent out the message about it. I said, guys, this is a very dangerous setup when we're looking at the daily chart on multiple stocks. And, you know, a good representation of that, of course, is the S&P 500. This is what's going on. Second attempt on great news at this level of 29.31. It fails. I pointed out in the chat room yesterday that this bearish reversal candle was forming. And the danger of this bearish reversal big freaking candle forming is the fact that we were just here 4 trading days ago. It gets here. Now, we were getting there on no apparent good news. Now we're getting there on super great news, and we failed to break above that. That is hugely bearish. And so that actually tells us now that this gap right here that we've identified in some prior videos, it's not going to be close. The market will reverse, and at this point, we are going back to this end of May, beginning of June levels, which were about 27.50, guys. So expect the market to unwind all the way down, possibly to 27.25, 27.50 level before it will actually resume the bounce higher, which could coincide with the Federal Reserve meeting in September. So we're not saying that the market all of a sudden today is going to get here. We're saying that over the next 2 weeks, we're likely to see the market somewhere around here. Now, our observation on the VIX versus the market, it's interestingly how we pointed out that What's going on with VIX at 2021 range when we're about 120 points off the highs on the S&P? So the issue with that is something is definitely different here with the market expectations for a further drop. So before that, in the last few videos, we've kind of ignored this, and we thought maybe it was just going to create a double top and then reverse. Well, yesterday we got exactly the opposite of that. It reversed, and now it's confirming the uptrend, which is highly dangerous because considering the way the VIX has been responding to the market conditions, we can actually see VIX at 32 in the next 2 weeks, guys. So here's another point I wanted to make. So we've been sending puts, and everything. At the end of the day, I was observing this volume, and I just couldn't resist it, right? On TLRY, you got this huge volume, right, going into the end of the day, all this volume coming in. You think, okay, institutions buying the hell out of the stock, all of a sudden you're at 4 million shares, you know, compared to all this prior days, right? And then they're literally doing it in the last hour of the trading session. They're buying a couple of $1 million worth of shares. You think like, okay, they must know something that I don't know going into this earnings announcement. And clearly what they did know is that the sales of TLRY were going to go up by 300%. Okay, but what they couldn't apparently calculate was the fact we're still going to lose more money than expected. Now, typically, guys, let me just explain. When you're looking at high growth stocks, it doesn't matter how much money a company is losing. Look, Amazon is a great example. It never stopped institutional investors from buying Amazon for 20 years when it was losing money every quarter. The only thing they cared about are the sales going higher because ultimately, okay, the bottom line, your profitability will adjust itself as long as your growth, you know, continues on a strong pace. Well, it doesn't get better than 300% growth, you know, but all of a sudden, they begin to sell the stock despite of all these positive developments on the chart, okay? And I'm trying to make a very good point. So look here, your RSI, steady move higher as the stock continues lower. RSI actually moves higher, highly bullish. Reverse head and shoulder, highly bullish. Look at all the gray bars. I mean, there's nothing but buying going into the earnings. I mean, accumulation. Look, finally picks up off this plateau. That's a very nice bullish move. Reverse head and shoulders on accumulation. Reverse head and shoulders on the price action. Bullish crossover in the MACD. Everything is bullish in this thing, okay? But what happens? The stock gets killed after the earnings report. So I'm going to take this as a sign to stay away from any calls and just short everything. Because if a good growth stock with all the positive developments on the chart cannot freaking rally, that is a sign that other stocks are going to report great sale numbers. They're not going to be able to rally as well. So there you go. O'Reilly, what do you guys see in this chart? Quick question. 1, 2, 3. Take a look at this chart. Take a mental answer in your head. I'm going to give you the answer right now in just a second. What do you see on this chart when you look at it? And guys, if you're looking at this chart and you're like, Leonardo, I don't see anything, it's a problem. You need to take the Charts Divergence course where we talk about the top 3 patterns for shortened stocks. You got to be able to look at this chart. You got to be able, within this, and like within a second, boom, I see this. Okay, it shouldn't even be an issue. Should wake up at 3:30 in the morning, I show you this chart, you're like, oh, Leonardo, of course, I see the head and shoulders. So, guys, it's easy, right? I mean, it doesn't get easier than this. O'Reilly Automotive, head and shoulders. So when the stock was going higher, what we were doing, we kept sending messages. Short it, puts. Okay? Look at this head and shoulder. There's a ton of other stuff. We don't have time to get into it, but AZO. Why we're looking at these 3 stocks, right? Because they're correlation type trades. AZO, what do you see? I highlighted it for you. Make it easier. Head and shoulders. So you got O'Reilly Auto Parts, which is also another important thing I want to bring up here. O'Reilly AutoZone. They're retailers. Yes, they sell auto parts, but you know, they sell auto parts to the general public. It's a retail type of organization. So retailers are showing head and shoulders. The importance of understanding this going into this week, okay, I'm not a huge opponent of buying options, okay, before the earnings report, but this is one sort of time exception that could be made because we're noticing this type of pattern in many retailers, and chances are they all going to be dropping after reporting earnings, because going forward from here, the profitability numbers are going to look like shit. Okay, and based off that, institutional investors are not going to buy these stocks. So retail sector is going to show some serious signs of weakness. So find pretty much any retail stock. So let's say 50 retail stocks announce earnings. Okay, well, you got probably an 80% chance that they will drop. 80% meaning out of 50 retail stocks that will announce earnings this week, about 40 of them are going to go lower, and about only 10 of them could potentially go higher. Okay, there's going to be some exceptions, right? You can't say unanimously 100% all the retail stocks are going to drop, but the overall predominant move in the retail stocks is going to be such that this week and next week, all the retailers are beginning to report. Most of them are going to be reporting that the predominant move in the retail sector is going to be lower rather than higher. So far we've taken a look at the O'Reilly chart, head and shoulders. AZO, head and shoulders. AAP, the stock that actually announced their earnings yesterday, right? Boom, head and shoulders. Guys, 3 stocks, same sector, same type of chart. Okay, so I've got some questions yesterday. Leonardo, why are you buying puts on these things? Well, because I can't ignore that every one of these things got the same identical head and shoulders pattern, okay, plus a bunch of other bearish stuff. So that's a good reason to short the hell out of these things. And where do you want to do? Guys, remember, what you want to do is you want to focus on shorting the bounces, not the lows of the day. You want to focus on shorting the bounces. If you've been shorting these stocks on the bounce yesterday, you would have been happy that you did, because all of them are going significantly lower from yesterday's highs. Now, Shopify is still on the course for a collapse. As a matter of fact, this is what we believe is officially happening today. Shopping for this stock is over, meaning that institutional investors are done buying this thing, and they're about to begin selling it off and locking in gains. Yesterday's market move was officially an 8. An 8 happens. An 8 is kind of a sister or a brother of the 4. It's just the difference between an 8 and a 4. We actually assigned the highest probability to a 4, considering this quick news. That move happened in the first part of the day, literally within minutes from the market open. In a move 4, you're going to see a move higher going into the second part of the day between 2 and 4 p.m. So it started with a small gap down, boom, small move lower, and then we got the news and the market rocketed higher and maintained its level. However, important to understand, 29.31, guys, 1 time, 2 time, 3 time, 4 times, guys. When you see this, okay, on great news, we should have broken above that, and we should have easily finished over 29.50, 29.60 on such great news, but we didn't. So when you see this key level, okay, even though this is a bull flag, okay, bull flags, they fail, just like top of the handles, they fail sometimes. So it's important to understand when we are going against a major level like that we've been talking so much about, it makes sense to just, go with the highest probability, which is the fact that that level will not be broken. 2-day sequence is 3-8. 3-8 looks like this. You guys know the 3, small gap down. Now here's the 8. 8 is a kind of a rare move. The big deal about the 8, typically it's followed by another bullish move. However, this is not the case here. We strongly believe it's going to be a move 3 today. 5-day sequence 4, 7, 12, 3, 8, followed by another 3 today. If that 3 indeed is confirmed today, guys, we're heading for a much lower, for a much more severe drop here. So this is how your 5-day sequence looks. The one unanimous trade here on this chart is the fact that you've got this move 11, move 11, move 11, small little pyramid throughout the course of the last few days, followed by a huge pyramid. And so when you see this, expect a bigger move, and in this case, that move is going to be lower, not higher. So possible head and shoulders developing is what we've pointed out on the chart of S&P 500 yesterday, and officially it is confirmed. See, we've identified this before the drop happened this morning. So head and shoulders, guys, if you don't know these chart patterns, study them and fully understand them. I'll include a link below this 13 market moves daily analysis, so you guys can sharpen up your skills if you haven't already. So next market move we're projecting for today is a move 3, market gaps lower. Tries to, at the market open, go higher. Look like oh, the bulls are trying to sustain the level, and that quick move higher is going to fail. We're going to reverse, and we're going to go lower from there. So VIX, as pointed out earlier, numerically is high, and uptrend is confirmed. So it's time to buy some puts. VIX is heading to 32 after watching this solid uptrend, the divergences, and more importantly, the response and the magnitude of the VIX move to smaller moves in the market. I think 32 is just around the corner. Now, key takeaways: focus on shorting intraday bounces, meaning buy puts when market is going higher intraday. And what you want to do is you want to buy this week and next week puts out of the money and stay with your positions for at least 72 hours. Guys, make the best of today. Tomorrow, lock in some serious gains over the next 2 weeks. I'll catch you on the next trade tomorrow.